We have lots of different types of investors on the platform. So first-timers, obviously, is what we've been talking about, but we have lots of advanced investors as well. So customers coming to Robinhood for our competitive crypto offerings, customers that actively trade options. And, during this time, I think it's a great opportunity for us to get closer to their needs, understand them, and build great products for them.
That was Robinhood CEO Vlad Tenev telling CNBC's Kate Rooney who and what he is seeing lately on his company's trading platform. Robinhood's gotten absolutely bludgeoned this year, but our next guest says that the bottom may be in for fintech more broadly, and the space is setting up to outperform the broader tech space in the second half of the year. Mizuho Securities senior tech analyst Dan Dolev joined us now to dive into his latest call. Dan, great to have you with us. Obviously, sentiment has really basically gone down to the basement at this point. I was going to say down to the floor, but when it comes to the space, down to the basement. So I'm wondering, that seems to be a major reason why you think that there's upside for the group, that there has been a re-rating.
Exactly, and thanks again for having me on your show. It's always great to be here. Look, we've done real work, rigorous work. We've actually analyzed almost 50 payment stocks and nearly 450 tech stocks. And what you're seeing is that they closely correlate, the stocks closely correlate with the growth. I mean, the 3-year stack, i.e. excluding COVID, it's almost like 100% correlation. What you're seeing now is that analyst expectations for the next 4 quarters are actually very modest. They're talking about a deceleration in growth. You would ask me, Dan, why do you think it's great? It's great because it can only go one way, which means it can only go up. So it prices in, the stocks are actually pricing in a pretty severe deceleration. And if things don't deteriorate dramatically, you should see those analyst expectations go up. And that would be a boon for a lot of these fintech stocks that we cover.
Dan, does it matter what the environment is in and whether or not these fintech stocks have ever operated in an environment like this, in which interest rates are going higher, there are great inflationary pressures on the consumer, et cetera? Or does that not matter in your model?
Well, everything, the macro always matters. If you think about some of the more, newer names like SoFi, for example, or Affirm, there was a great deal of, controversy and fear heading into the quarter, following the Upstart earning, for example. And the most interesting surprise was that actually everything was fine, right? They were beating, they were raising, they were making money in the case of Affirm, which everybody thought, couldn't happen. The delinquencies are, not growing. The high quality borrowers are stabilizing. So I think that there's a lot of fear out there, but the reality is that these business models are more stable than a lot of people give them credit for.
Dan, it's Karen. Thanks for being on. Let me ask you about credit quality. So in your model, you must have some scenarios where credit quality gets worse. And so how much downside do you think, an Affirm or a SoFi might have in a worsening but not cataclysmic credit scenario?
So I think this is a great question, Karen. I mean, look, I think that it right now, given, we live this space, right? We talk to investors all day long, right? And I'm sure the same people that we talk to. And I think right now, we're at that epicenter moment where it basically prices in, I wouldn't say a disaster, but something close to a disaster. So I think the downside, kind of in our bull-bear scenario, we're kind of very close to that bear moment, which means that there's more upside than downside. So the downside, it doesn't get much worse from a sentiment perspective. I mean, this is from our broad conversations. Again, I'm looking at sentiment versus reality. Of course, things could deteriorate down the road. I can't predict the macro. I checked my crystal ball today and the battery ran out. So I have no idea, what actually is going to happen. But so far, the evidence shows that things are pretty stable despite the fear.
You should try plugging it in, Dan. In terms, when you say, that there's a lot more downside, I'm just trying to figure out, at what point do you get concerned about credit quality? Because we've been operating in an environment where consumers have no excuse to have bad credit. They've been getting free money from the government. They've been getting free money in the form of interest rates. They have no excuse to have bad credit. And so I would imagine that there's sort of an inflation in credit scores. And so when you start taking that away, that the downside could be much greater than we think.
And again, I want to point you to, let me give you some real numbers, which I thought was fascinating. In the case of Affirm, buy now, pay later, it's kind of the, this should be the focal point of credit issues, right? Kind of borrowing without FICO. In their measure of credit, every quarter until this quarter, the percent of borrowers on the highest kind of quality borrowers came down, i.e. they were getting worse. In this quarter, it actually leveled out. It actually not gotten worse. So I know there is, a lot of fear, but the evidence shows that, the business model isn't necessarily, getting into that adverse selection of, worsening, deteriorating credit quality. What would the future look like? I don't know, but so far, very stable and very strong.
Dan, great to speak with you. Thank you.
Thank you.
Dan Dolev of Mizuho. Steve Grasso, you like any of these names?
Yes. I mean, if you look at if you're talking about a bounce off the bottom where people have overestimated the downside, Affirm is down 75% year to date and 28% for the month. That's way outperformed in a bad way both SoFi and Robinhood. So if you want to throw something at the wall, I would say take a look at Affirm here. But I don't know if in his model, and you and Karen were getting at this, priced in recession, and is it a hard landing? I didn't get that from you. We were talking about credit quality, but I didn't get that exact answer from him.
Yeah. Guy, what do you think about the notion that some of these companies never operated in an environment like that? Does that matter?
No. I mean, I understand that, but there are a lot of things that people haven't operated. And listen, the last 13 years, for a lot of people, nobody's seen markets like we're seeing now based on a Fed pivot. So, I mean, a lot of people are dealing with situations that we haven't seen before. So I'm not looking to give anybody a free pass. I'll say this. PayPal traded down pretty much to those March 2020 lows and is subsequently bouncing here. I think for a trade, PayPal looks interesting. But that's coming from somebody that thought PayPal would stop going down probably 35-40% ago. But at these levels, it might be interesting, especially given that they reported at the end of April, guided lower. All the bad news seems to be in. So PayPal for a trade.